What really never ceases to amaze me when it comes to Wall Street and investing in general is just how sentiment can change on a dime. I mean, it was literally November. The animal spirits were out. We're in this incredible economy. Things are never going to be better. It's a golden age for the USA. And now all I can hear about for the last week or two, it's growth scare. We're concerned about manufacturing. We're concerned about tariffs. We're concerned about the consumer. We're concerned about inflation, and the list goes on. And it's just like everyone who is so bullish all of a sudden has become so bearish. And as you like to say, Bob, that's why it's so hard to invest.
Yeah, it is. But I'll tell you what, I love these huge down days because then I can get my calculator up and I can tell you right now, if you have 700-point down days, it only takes 61 days for us to get to zero on the Dow. And I'll tell you what, that will be the buying opportunity of your lifetime.
Because you get to own all those physical assets, right? Contrary to popular belief, stocks just aren't paper.
I always wanted that jet, Rye. I want to manage the Square Garden, and I want a jet. So this is our opportunity. So sell, sell, sell. But we're, markets never go to zero. And I think that's one thing investors don't ever get into their head, that markets go down, but they always recover.
Yeah, I think what's really interesting is when you look at the sentiment levels, so you actually track these weekly and you send these to all the advisors, but the AAII investor sentiment levels are at, how low are they? They're at
19%. It's abysmal. It's like as low as it's been in the last couple of years.
Exactly.
Yeah.
And I think what tends to happen is you tend to still have that euphoria of people buying in, but right now you have everybody just ready to push on the sell button, which almost as a contrarian makes you think this probably is a buying opportunity and not something to run away from, right?
I think it's the old proverbial be greedy when others are fearful. And I think right now, more than ever, it's like the dynamics, and we said this a couple weeks ago, of the economy really haven't changed that much just in a couple of weeks.
Well, it hasn't because, we look at literally hundreds of portfolios that we don't manage, right? People who are bringing their money to us for us to consider managing. And the majority of the accounts that are run by people that run their own money or run by other advisors have been so overweighted in equities, so overweighted in the highest risk investments. And the thing that really blows our mind is, number one, people expect 20% annualized returns. And secondly, they think corrections will be like 5 to 10%, that there's no way that this high risk leverage strategy they're following could go down 50, 60, 70%.
Well, that's a great point. I mean, we always go by our most recent experience, and let's face it, we haven't had that many significant sell-offs. Even during the pandemic, the market was down 20%, or the S&P was. That's not the same as the 50 to 60% drawdowns we saw during the great financial crisis or when the dot-com bubble burst. And to your point, Bob, right, there's this like crazy belief right now that you should get higher than historical returns on the upside and your downside to be more limited, which we know is just ridiculous.
Yeah, and I think something that shouldn't get lost with all of the headlines right now and how much the S&P or the Dow is down is not everything is down, right? Like even yesterday, markets were down a few hundred points, but you had things like real estate, utilities were actually up. We've been talking about this year, but Europe has actually outperformed the US. China is up today, even with the S&P 500 being down. And I think we get caught up in these headlines and what the US is doing, and especially when Trump has all this America first rhetoric that he talks about, we forget about the rest of the world, which is still doing great. And, that's why we want to be a diversified investor, is because a lot of our clients' portfolios are still up for the year, even though the S&P is flat.
Well, you're missing one big asset class, Court, bonds, right? The interest rates are down. Bond values are up, whether it's treasury bond or a corporate bond or a municipal bond. And the beauty of bonds, when you have a balanced portfolio, is number one, when rates go down, they go up in value. And if the market gets to a point where it's just going to become a phenomenal buy, if you don't have any bonds in your portfolio, you don't have any fresh cash to invest. You're just sitting there watching your portfolio go down.
Yeah, no. I think it also speaks to just the irony of investing, right? Who would have guessed? We said this before, but like China would be up, Europe would be up, given the fact that we have this American first policy going on. You would think it would be the opposite, but the dollar is weakening. Interest rates have come down a lot, which has pushed our bond prices up. I think this is just like textbook why you diversify, because when things change, it's going to be completely unexpected, and it's going to be in a way you wouldn't have factored in ahead of time. Like nobody was calling for the situation we're in right now. So it just comes down to always having your bases covered. And to your point, like we look at so many portfolios, nobody's been prepared for this. Maybe we have, not to sound Pollyannish, but this is why our diversification works.
Well, it's not so much that you have to be prepared for it. It's just when you have a diversified portfolio, it's like taking Chris's sailboat out and sailing through the Everglades, right? You need to have to know how to navigate, right? If a sandbar comes up that you'd expect, you need to be able to, make the turn at the proper time. So, the reason we're long-term investors, the reason we're diversified is because you can't time these things. But you also you have to have fresh powder, in your portfolio to be able to take advantage of it. If you're not liquid, you're not diversified, you can't take advantage of opportunities, right? It's not just about buy low and watch it go high forever. You have to be able to move and make these changes when it's appropriate.
And I think this is just a good example of why this is time tested, right? Like, I think if you looked over last year, there was a lot of headlines on the media saying, oh, is the 60-40 portfolio dead? Like, that was a constant conversation people were having. You also saw people were saying China's uninvestable. Like, people just start to throw it out the window and say, you just want to own the Magnificent Seven, just these 7 companies. That's all you need to do, and you can retire. And that's just not the case. And that's what we've been arguing for a long time. But things are going to shift, and they are shifting. This is why you have to make those changes to be diversified, even before, when it didn't look like, anything other than those 7 companies were going to be your best performers.
Well, and the other thing is, too, is this has been a very small correction. That's the other part of it, is people get so skittish so quickly, right? Everybody thinks when the market's going up, I can handle a 10% drawdown, 15% drawdown. We're not even talking about a 10% drawdown right now. If you look at it, most markets are off a couple percentage points, and people are running around like their hair's on fire. So never mind. And look, we've got the scars on our back to prove it. We've been through some 50, 60% corrections. Like, that is really scary, but nobody thinks about that when the times are good. And again, just a small correction, and all of a sudden people are just like freaking out. It's crazy.
Yeah, but it is amazing when you see how quickly greed turns to fear, how quickly, exuberance turns to despair. And, everybody just focuses on the negative headlines as opposed to, well, oil's going down. That's a tax cut for every, and consumer, every company in the world. Interest rates are going down, right? That's a bonus for every company, every investor in the world, right? Earnings just finished a quarter where they're only supposed to go up 8%. They went up 14%. And the quarter's just ending. It's like, oh no, the world's ending now. Forget about all this good news. We want to focus on all the bad news. And really, all it is just the uncertainty of what's going to happen tomorrow.
No, it's a great point, because if you just zoom out a little bit, the big picture really hasn't changed, right? And if you look at the employment market, still very strong. People have jobs. Wages are going up over inflation. Inflation's come down a lot over the last couple of years. So like the big trend hasn't changed at all, but it's like these short-term hiccups and uncertainty, Bob, like you said, all of a sudden derail people's complete investment game plan. That shouldn't be the case. You got to keep your eye on the prize. And I think, that's what we've done, I think, really well, is we've constantly looked at that big macro picture. And from where we're standing, it kind of looks the same right now, just as good as it's looked when everyone was screaming about recession for the last couple of years, and it didn't come to fruition. I suspect it's going to be the same outcome this time around too. The smoke's going to clear, and it's going to be, wait a second, what was everybody so worried about?
Well, whenever you get a bubble-like move in something like AI stocks, right, in the Mag 7, suddenly a lot of investors then become traders, right? They become experts. And, instead of being an investor and staying invested, they think they can time these things. I mean, I cracked up when I was reading Barron's this weekend. The analyst at Morgan Stanley, whose specialty is China, right? He's been saying China's uninvestable. But now that it's up 60%, he's taking his position from an underweight to a market weight. Well, thank you very little.
I mean, that's Wall Street in a nutshell right there. Let me tell you what happened yesterday. But wait, let's wait till the trend is so blatant before I make any sort of decision. And that's why I think the worst investment strategy you can possibly have is anticipation. Because whatever you anticipate, I can promise you, markets are cruel. It's not going to happen the way you think it's going to play out. That's why you've got to have a strategy that's based on your goals, that's based on anything that happens, you're prepared, because we just don't know what the future is going to look like. If we did, we'd be on our yacht.
The most important thing is, Ra, you're right. This has been a small correction. It's just starting with a pullback. We haven't seen a pullback in 2 years. So people think, wow, this is not normal. The worst thing you can do as an investor is panic and sell everything. Say, I'm not taking any chances, because the biggest problem with that is you'll never get back in. And this economy has been resilient. We've been telling you for the last 3 years, we're not going to have a recession. The economy is resilient. We're going to keep betting on the resilience of the economy. The key here is not to panic, is to stop being a trader, stop thinking as a momentum investor, and go back to being a long-term investor. You'll sleep better at night.
Hey, hope you're enjoying the most recent episode of Pain Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, brokerage product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paincm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, this is the tipping point. This is where we pinpoint the pain point. Of course, that's P-A-Y-N-E, having the biggest impact on your wealth right now. And guys, today we're going to do a classic spotlight segment where we actually take a real case we worked on. We talk about an individual or a couple, what they're doing for retirement, how they're planning. We break it down. We say, here's all the pitfalls. Here's how we help correct those pitfalls to get people on their path to financial independence. And Corey, you worked on a pretty good case lately. Why don't you break it down for us?
I did. They came to us because they are now starting retirement. And the good news is they were able to retire before age 60, which first of all is a very good feat. But the problem that you're facing when you have an early retirement is you have a long lifespan. So you are planning for your money to last a very long time, and inflation is going to be your biggest enemy. So the first thing we had to do is figure out, okay, is your money going to outlast you, or are you going to outlast your money?
So I'm curious. The reason that they contacted us, my recollection is because the husband was thinking about retiring, correct? Like it was time for him to say, I'm going to live off the land.
Yep.
And I probably need someone else to look at this to see if I'm on track.
Correct. And a majority of their money is in a retirement plan at work. So they didn't have somebody who was managing their money or necessarily to plan with their money. And they were saying, well, this is probably a good time that we make sure our money is actually working for us and going to meet our goals.
So based on your initial analysis, Court, were they positioned so that their money would be in a position where they won't outlive their money, or was their money going to outlive them?
So they luckily in a really good position where we said you can get a pretty conservative rate of return. Like even at a 5% rate of return, they will have more interest, more dividends, and more growth than they need, which means they can have a conservative portfolio and their money is only going to grow throughout their lifetime. But then what I did is I take a look at their investments. And do you guys want to guess how aggressive or conservative they were?
Well, I'm looking at the case I'm looking at the proposal you put together, and they're 80% in the market. Now,
they are 92% in the market, right?
They're 92% at risk in the markets, which, that's great when you're 20. You don't have to worry about your portfolio for a long time. And we see a lot of that right now, right? That baby boomers, they're getting into their late 50s, early 60s, 70s, and their portfolios are positioned like they're 25. Now, great when the market's going up, but we know if you're 92% equity, man, oh man, your downside risk is tremendous.
Exactly. And that's what you want to look at is saying, okay, if you can get a conservative rate of return, your money is going to last throughout your lifetime. This is probably a good time to reposition, because otherwise what can happen is you stay 92% equities, there's a big downturn in the markets, you're down 40 to 50%. That can actually affect your retirement and cause you to go back to work. And that's not what we're trying to accomplish here.
And I think if you just look at it logically, you think, well, markets go down, but they always recover. But I don't think most folks understand when you are retired and you're no longer having that paycheck come in, that safety net, that you now have to pay your bills with relative performance. When the market's going down, when you're retired, it doesn't seem like it will ever recover. And it's almost impossible not to panic in that scenario. And I've seen that happen. We had that in 2000 and 2008, where we had clients who wouldn't listen to what we had to say, fired us, ended up, going somewhere else. And then a year or two later, come back knocking on the door saying, well, we only have half left. Could you take us back and put your plan back together? I mean, it's funny, but it's sad. It's so sad.
It reminds me of that Mike Tyson quote, everyone has a plan to get punched in the face. And I think,
yeah.
but I think what's interesting about this case, and I think this is very indicative of a lot of people right now, is until we put all their assets on one place on a spreadsheet so they could see their allocation, the husband, he didn't even really know that they had this kind of risk. And I think most of us don't realize it's not until we see where our 401ks are, our brokerage accounts are, and how they're all allocated together that you can really get an idea where your risk is. Because I think most people, it's not intentional that they have that much risk. They just don't know it.
So, Cord, they did have 92% in risk assets, equities, basically, but they did it 8% in cash. Now, was that, were they thinking they didn't want to invest in bonds, or that, money market rates were 5% or 4%, that they didn't need to lock in those rates? What was the thinking?
Well, they did. I think it adds up too, right? You say 8% in cash, but that was $200,000 in this case for this.
$250,000.
Yeah, that's real money. And again, it's like, I think a lot of times you're not aware of it because maybe you have a little bit of cash in this account. You have a little bit of cash in that account, and it adds up, and all of a sudden you have hundreds of thousands of dollars sitting in cash accounts. And that becomes a problem when the Fed's been cutting interest rates and your money market fund went from 5%. Now it's under 4%. It could be closer to 3% by the end of the year. And this is where like putting your head in the sand and not addressing these issues has a major impact negatively on growing your money long term. And most of us just aren't addressing it.
And I think these are problems that a lot of people face, where you are really good about saving your money. You're putting money into your retirement plan at work, but then you don't think about it, right? So you're putting it in there. It's getting invested for you, but you haven't looked at it in years. So you're still invested like you were when you were 20. There's still some cash accumulating. You don't realize how much it is, but it's not something I think anybody should be faulted for. It's just like you do need to look at this, have somebody do a review, especially every few years. Make sure, are your goals still the same they were 5 or 10 years ago, or should you be making changes to your portfolio? I would say probably most people should be, but it's easy to just not look at it, just set it and forget it. And I think that's what happens in a lot of cases.
Yeah, I think it's happening a lot because you see trillions of dollars still sitting in a money market fund, while interest rates are dropping like a rock. I mean, a 3-year treasury now is under 4%. The money market funds are all under 4%. If you're sitting at a bank, they're only paying you 1/10 of 1%. So, no harm, no foul there, right? The banks don't have to pay any interest.
Yeah, and the other thing too is what I love watching when you do this analysis, we show you how much cash flow could you be generating on your money. As Chris likes to say, who's out sailing right now, is you get a better outcome with income. And what I love about this portfolio is by re-diversifying it, better spreading the money out, taking less risk, you're able to increase the income by like a pretty sizable amount.
Exactly. Yeah. So I'm looking at the analysis we ran, and they're currently generating about $44,000 a year between interest and dividends. And just by reallocating this portfolio, making sure it meets their goals, we're able to increase that to more like $94,000 per year. That's an extra $50,000 of income that you're getting, which means you don't need the stock markets to go up a single dollar. You're just generating that every year. And especially a client like this who doesn't need the money, we're just reinvesting that and buying more investments every single year for you so that down the line when you need it, you have more that's growing.
Well, I'll tell you one thing. I know you're not going to recommend, Court, as you've been repositioning its portfolio, is this annuity we just transferred in from one of our existing clients, where after 18 years of taking risk in this guaranteed investment, what would you guys guess was their annual average rate of return?
Usually low on annuity. I'd guess what, 2%?
Wow.
Yeah.
Courtney, it can't be lower than 2%.
How about 0.2%? I mean,
Jesus.
barely made any money net of the fees from the insurance company. 18 years, they had $200,000 that, with a conservative balanced portfolio would be $500,000-$600,000.
Do we think the insurance company is taking a lot of fees out of that? I wonder. But they say there are no fees. I don't get it. And I think that's the wild opportunity right now, right? Is by just allocating your portfolio to liquid assets, because annuity, once you turn that income stream on, it's not liquid, is you can generate a huge stream of income right now by having, real estate in your portfolio, having real estate investment trusts in your portfolio, having energy pipelines in your portfolio, having a global portfolio where the yields are higher. There's just so much value in having diversified sources of income, and you can do that with a liquid portfolio where you don't have to lock your money up It just drives me crazy.
You guys know the bulk of my clients have been retired for a long time now. They have, income streams that have been generated year after year. We just transfer, a fixed amount of money to their checking account wherever they live locally. And I got to tell you, the conversations I've had with them month after month, year after year, is never about the stock market or the bond market or even the tariff tantrum that's going on in the market right now. We talk about their grandkids. We talk about their golf game. We talk about their boating trips or their cruises. I mean, it's just amazing how comfortable it is to be in retirement, to truly have a portfolio that can outgrow inflation and, continue to give you the lifestyle that you want, that all of us want, when we do finally retire.
Bob, sign me up. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, according to the LSEG Lipper data, the average U.S. equity fund rose 17.4% last year. Hence, most money managers got trounced in 2024 by the S&P 500, which rose 25%, lifted by the Magnificent Seven of Apple, Amazon, Meta, Microsoft, NVIDIA, and Tesla. Chipmaker NVIDIA led the way with a 171% return, powered by the artificial intelligence investing boom. Hard for those managers to beat the index.
Well, Rod, that's just matches what history has demonstrated since they've been keeping data, on professional money managers. So it goes back, almost 100 years. This is just typically what happens. So there's two things. Number one, why do mutual funds even exist any longer? And second, why would anybody join the investment club so you can spend all day studying a handful of stocks so you can underperform the index?
Are you trying to say that Jim Cramer underperforms the market?
I'm not saying it. He's documented it on his site. Just go to his site. He'll prove it to you.
I wish you would have told me to go long NVIDIA at the beginning of last year and got out in the last couple of months while I was doing nothing. That would have been...
Yeah, well, truth be told, buddy, he nailed the top on NVIDIA when he named his dog NVIDIA.
All right, Courtney, yes, the top 10% of U.S. earners accounted for 49.7% of all consumer spending in 2024, which is a record high since 1989, according to Moody Analytics. Sound like the rich are just getting richer.
Yeah, and this is the problem when you look at like consumer spending data is like on a whole, the consumer keeps spending, but then you actually break it down. And the problem is like the high end consumers are still spending. Your lower end consumers are really having trouble with inflation. So this is where you're seeing things like luxury goods and things like that are actually have better outlooks right now with the economy. It's why we have to continue to watch inflation because that's obviously affecting a lot of the consumer.
Yeah, I mean, it's really the middle class that always gets squeezed in this country. And I think, right, when you look at the data, it doesn't exactly tell you that.
Exactly.
Which is wild. Okay, Bob, Trivariate Research's Adam Parker notes that the stocks most loved by Wall Street analysts have underperformed that have been hated by Wall Street analysts by 30 percentage points since 2001. Okay, for example, the two biggest losers this year, Edison, which is down 31%, and West Pharmaceutical, which is down 29%, had 55 and 67% buy ratings by the strategy, whereas Super Microcomputer was up 37% so far this year, only had a 30% buy rating, and CVS, which is up actually 48% this year, which is wild to me, only had a 55% buy rating. These analysts make fortune tellers look good, Bob. Warren Buffett wasn't.
Rod, it comes back to the old adage that Wall Street is full of ordinary people who pretend to be able to do extraordinary things. I'll never forget the mutual fund conference I was at maybe 40 years ago, where one of the mutual fund managers said, look, every one of us claims to be a contrarian, but we're not going to state a view unless we think that everybody in the audience agrees with our view. So it's very difficult to be a contrarian. Basically, Wall Street research isn't really worth the paper it's written on.
Hey, hope you enjoyed episode 195, Pain Points of Wealth. If you love our podcast, you really love our podcast, give us that 5-star rating on iTunes, Spotify. Don't be shy. Let people know about our podcast, please. Your support gives us support to continue to do this podcast. And this is on YouTube right now. You can like this episode, subscribe to our channel, click that notification bell to be updated every week of all our new content. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Pain Points of Wealth, Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Brian, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.